Mohit.
Thank you for taking the time to explore Singapore's variable capital company with us today, and welcome to today's webinar. My name is Roderick White, CEO of Krypton Fund Services, and I have the privilege of moderating today's webinar on Singapore's variable capital company with our esteemed panel. With the introduction of the variable capital company, Singapore is elevating its position as a prominent option as a fund jurisdiction in the asset management market. Herein, and through the remainder of the webinar, we'll be referring to the variable capital company structure as VCC, which is commonly known in the market. Today, we will cover the following topics with our panel of experts. History of fund structures in Singapore and why now the VCC structure. The expected utilization of VCC and an update on the pilot launch program, which I believe has 20 fund structures. Anti-money laundering and countering the financing of terrorism, or AML-CFT, the VCC grant scheme, re-domiciling of funds, custodial requirements for the VCC, corporate governance, board of directors, India access via foreign portfolio investors, or FPI. Lastly, if we have time, we will open up for questions. However, any questions that are submitted during the webinar will be consolidated and answered following the webinar if we do not get opportunity during this call. At this time, I would like to give each of our panelists an opportunity to provide a quick summary of themselves, and I would like Rachel to start.
Thank you, Rod. My name is Rachel Ng. I am the Managing Director of the Singapore Faculty. We are Singapore Law Firm and it's part of PwC Network.
Hi, Rachel. Sorry, I couldn't hear you. Could you speak up just a little bit, please, for the webinar?
Okay. Is this better?
Yes, thank you.
Sorry about that. My name is Rachel Ng. I'm the Managing Director of Ng & Co LLC. We are a Singapore law firm that practices in 11 states. We are a network firm of PwC network.
Perfect. Thank you, Rachel. Mohit, can you give us a quick overview?
Sure, Rod. So my name is Mohit Batra and I work with Edelweiss in Singapore. Edelweiss, as some of you know, is one of the largest India access providers based out of Singapore. So we work with funds and managers here who are looking to invest in India, whether listed or non-listed. And all the related India nuances, fun and games like setting up a custodian ID, tax IDs, settlement accounts, trading clearing, all of that is what we take care of from an India markets perspective.
Perfect. Thank you for that overview. Steve, can I ask for an overview, please?
Sure. I'm the managing partner and CEO of Swiss Asia Financial Services. So we're a hedge fund incubation platform. So we actually help all sorts of hedge funds ranging from crypto all the way to private equity form and launch and operate hedge funds from Singapore and Hong Kong.
Perfect. Thank you, Steve. And next we have Martin, not lastly, but thank you, Martin.
Thank you, Rod. I'm Martin O'Regan. I've run a company called Solids Fiduciary Services. We provide independent directorships to fund managers, asset managers. Historically, it's been Cayman and Bermuda and in some of the offshore jurisdictions, but recently, over the last sort of 18 months, more and more we're seeing Singapore and somewhat Hong Kong as well. So, if there are resident directors needed for VCC and downstream in the VCC, then that's a function we can provide.
Perfect. Thank you, Martin. Now that we have introduced the panel, let's jump right into the content of the call. Steve, I'll hand this one over to you. Can you give our audience today a brief history of the fund structures in Singapore and provide some insight as to why now the VCC structure?
Yeah, well, I think we've currently, from what we've seen, and we've been operating for 15 years in the hedge fund industry in Singapore, and the only options you used to have in Singapore was either a Singapore company structure and or a limited partnership type of structure, under which you could actually set up a fund. It was not very efficient, of course, and even though you had the tax exemptions, it was efficient from a taxation point of view, but wasn't efficient from a corporate structure point of view. Now with the VCC, I think we're actually getting the best of all worlds. I wouldn't even say two worlds or three worlds. I mean all worlds. We've got Asia, Luxembourg, Cayman. And we've seen VCC has come out as an extremely efficient vehicle for setting up funds, and you've got umbrella funds, you can redomicile, it's extremely tax efficient, and I think from that point of view, we're really going to see a huge uptake from investors that are investing out of Asia and into Asia and even globally. One big matter is probably also the fact that Singapore actually has double taxation treaties with most countries in the world, where, for example, Cayman doesn't. So there's efficiencies to be seen across the board in terms of structure, in terms of costs, and in terms of taxation. I think from there, I think we're very, very bullish on the prospects.
Perfect. Thank you, Steve, for that overview. Martin, can you give us an overview, I guess, how managers can utilize the VCC structure and structuring? And then secondary, just give a quick update on the pilot program, which I believe has about 20 fund structures currently going through the pipeline.
Yeah, sure, Rod. The pilot scheme was really to kick the tires and test the system internally within the various bodies within the Singapore government, from the MAS to ACRA to IRAS, and the number of 20 funds was picked. It was to use across various asset classes, from hedge funds to private equity, real estate. There are some AI funds, long short equity, etc. So it was to give a broad base of the portfolios. There were some master feeders. There was some redomiciliations as well. So it's to really test the infrastructure and get things up to speed, and 20 was a good number to start with. So that launched on the 15th of January, so it's 20 funds with 18 managers. We've heard that following the launch after 15th of January, there was another 5, and there's another 4 in the pipeline. So probably by the end of this month, there's probably going to be close to 30 funds that will be active in the VCC space, and all of us as service providers are getting a lot of interest, and people are looking at it, not just in Singapore, right, but regionally we have people looking at it as well. A lot of interest from Australia, and one of the reasons for utilizing VCC, which is the first question, is that distributing and marketing Cayman funds in certain parts of Asia is not ideal, and certainly in Australia it's a no-no. The VCC ticks a lot of boxes from a distribution play, and the credibility factor of Singapore, the tax efficiency for Singapore, just makes it very attractive. So, in the first 6 weeks of launch, we're going to have close to 30 funds, and that we do see a lot of appetite for it as well. So, so that's the pilot scheme in a nutshell. On the utilization of it, we are seeing hedge funds, PE funds. If you're in Singapore, or if your assets are in Asia and your investors are in Asia, if you're a Singapore manager, then it's a bit of a no-brainer, really. You know, Singapore now gives you the flexibility and the functionality and the same tax equivalency as Cayman. So we see a lot of the Singapore managers on the hedge fund side use it. Private equity real estate are also looking at it as well, because it has the umbrella structure. It's quite useful on the private equity space, particularly on the smaller funds, where when you're opting for the tax incentives in Singapore, there are various benchmarks and hurdles and AUM thresholds that you need, but they are eased up on the VCC. We'll talk about the tax incentives later, I guess. But yeah, that's a little bit of a summary on the pilot.
No, this is definitely a great start when you definitely compare against other jurisdictions like Hong Kong, which is slow to start to the market. Seeing 30 funds in the pipeline seems like a great start for the VCC structure. Thank you, Martin, for that. Steve, can I hand back over to you for a couple minutes? And I guess one of the questions that I'm frequently asked is, how does AML CFT work with the VCC structure? Is there anything unique with this new structure or that should be considered, or is it pretty much status quo like you would typically see with, say, a Cayman fund structure?
Well, I think to be very, pragmatic on the approach. I mean, when you're managing as a Singapore investment management company, you know, you're licensed by MAS. You typically you need to do, you're number one, you're fully responsible and liable for all AML and KYC, and identifying source of funds, source of wealth, etc. So all that needs to be done on all of your investors. Now, typically what happens is fund administrators and with Cayman funds will also have an obligation to perform AML and KYC. They can, of course, delegate that down to the investment management company or to a third party that is actually doing it. So you have a function of delegation. So it does bring additional costs from the fund admin perspective to perform this activity. So if you're looking at it from a pure VCC structure then, and you're evolving where you're saying, okay, well, as a regulated entity, as the investment manager, I'm the one responsible. I'm the one doing it. So I choose whether I outsource or the process or to a certain extent. But there's no more multiple parties involved in actually completing that AML and KYC process for investors. So I think it's streamlining the procedure. It has to be done anyway, but it's clearly streamlining. It stays in Singapore. Responsibilities are local, and everybody understands let's say it's a one AML policy, and you don't need to look at the differences between a Cayman policy, a Singapore policy, etc., and then try and merge the two. So you're just it's probably going to, or it is for sure going to streamline things quite a lot from a procedure point of view and also from a cost point of view for performing AML and KYC on investors. That's my point of view. Yeah.
Perfect. No, thank you, Steve. I think that was a great overview. Just a reminder to everyone attending today's webinar, feel free to ask any questions on the question and answer panel located on your screen. Any questions we will look to try to answer at the end of the webinar. And if time doesn't allow, we will basically follow up post the call, probably in a couple of days, with basically a number of questions and frequently asked questions that we've received. A topic that's gathered a lot of interest in the market is the VCC grant scheme, actually, which I think is quite unique and probably part of the success of the early adoption of the VCC. Rachel, can I ask you to provide an overview of this program?
Sure. So I think everyone's very excited by the grant scheme. Currently, based on what is published by MAS, that MAS will co-fund up to 70% of the eligible expenses, but the qualification is paid to Singapore-based service providers. In terms of quantum, the grant is capped at $150,000 for each application. The good news is each manager is able to apply for the subsidy for up to 3 VCCs. In terms of the period of the grant scheme, it takes effect on 15 January and managers can apply for the next 3 years up to 15 January 2023. Listed by the FSDF, which is the Financial Sector Development Fund under MAS. So for anyone who is interested, they can write an email to fsdf@mas.gov.sg
singapore.gov.sg.
Perfect. Thank you for that overview, Rachel. And actually, leading into our next topic, I see we have a question on this as well. Many existing managers will question whether you can redomicile a fund to Singapore, and I guess more in particular into the VCC structure. Rachel, can you provide some insight into that question and also highlight some of the key factors that managers should consider when redomiciling?
Sure. So basically for the grant scheme, the subsidy will actually cover costs for both newly set up VCCs as well as redomiciled VCCs. So for managers who are not ready to launch a new VCC, they have the option of redomiciling their existing fund, which is in overseas jurisdiction at the moment. Just briefly touch on a few key features or key requirements of redomiciliation. First of all, the laws of the place of incorporation must allow the transfer of the incorporation to Singapore. In most of the commonly used jurisdictions like Cayman, Mauritius, BVI, they are already used to such redomiciliation and have established laws for redomiciliation. Compared to the redomiciliation of corporates, for VCCs, the MAS has dispensed with any quantitative requirement. So there is no minimum threshold at which funds are allowed to redomicile, so long as they satisfy the various other requirements. Just briefly touching on the requirements, it's the structure of the current fund must be in a form that can be that's similar or can be adapted to the VCC structure, which is a body corporate that is in the form of a collective investment scheme. And some other general requirements, for example, if the fund must not be under winding up or receivership in the current place of incorporation. The application for the redomiciliation must not be for any bad faith purposes, and also they, in terms of the assets and liabilities, the assets of the fund must exceed the liabilities of the fund in order to be able to redomicile to Singapore. In terms of timing, the rules have generally mentioned that it may take up to about 2 months from submission of all the requisite documents to ACRA. I think given having looked at the documentation and participated in a pilot process with a number of clients, I believe that just the application for redomiciliation process should be able to be completed within 2 months. But I think managers have to give themselves a bit of more time in the front end to analyze their own funds and investments to assess the feasibility of the redomiciliation. So I think more time will be spent in the upfront analysis.
Perfect. Thank you very much, Rachel. I guess it's safe to assume that basically anyone considering a redomiciliation of a fund structure should definitely talk to, especially the board of directors and all the service party providers associated with the fund and their legal counsel, and also legal counsel within Singapore as well. So thank you for those updates. Custodial requirements is one that requires some clarity from my standpoint, and I've had a number of questions on this topic. And I guess, Martin, can I ask you to provide us with some visibility on this?
Yeah, it caused some confusion in the early days, Rod, during the consultation period, and it has been clarified and some amendments have been made. But essentially for what's called the restricted schemes, which is essentially what we know as alternative funds, if you have a hedge fund or a liquid strategy, then you do require a custodian. If there is foreign assets and foreign exchange, then you can have a custodian outside of Singapore. If not, you will need a Singapore-approved custodian, which is a CIS, what's called the Collective Investment Scheme approved custodian. So the MAS listened to the feedback from the industry, and with regards to private equity and private assets, then you won't need a custodian for those assets, because typically they can't be held in custody. So that was a great change that was well appreciated by the community. There is no, you don't apply for an exemption for the custody in the private equity space. You actually have to put it into your subscription agreement. The investor has to acknowledge and accept that there will not be a custodian for the private equity funds. So you'll need to put it into your subscription agreement, and you'll have to a tick the box exercise by the investor on that. So that's in the alternative space. On the retail space, which is the authorized schemes, that has been parked for the time being. That will be in VCC 2.0. The idea was to get VCC off the ground and get it up and running, and then move to the retail schemes as well. So, so there will be, as with in the old regime with retail funds, there were unit trust, a custodian was required as well, and the Singapore approved CIS Collective Investment Scheme trustee. So once the retail schemes come back online, you'll need a custodian for sure. So, it's really for hedge funds and liquid assets and assets that can be held in custody. Then you'll need a custody for those. So that's the background of the custody, Rod.
Perfect. No, thank you for that, Martin. And I guess even for service party providers, I guess just in regards to the private funds, having the actual check the box exercise on the subscription forms is something that should be noted and adhered to ensure that basically you can avail it.
Yeah, you will need it. It will be checked. So, yeah, you will need it.
Yeah, perfect. Thank you for that. We mentioned earlier Australia, but now focusing on a market that I see quite a bit of demand for the VCC structure, or at least a lot of conversations for. India is a growing market that we're seeing either adopting the VCC structure or definitely inquiring. Today, I'm happy to have Mohit on the panel and ask him to discuss the India access through an FPI.
Thanks, Rod, and good segue to a slightly topical part of this webinar, which is India access and relevance to the VCC. Now, we've been talking to a lot of managers who've given us some feedback on how this is relevant, and I'll quickly cover some basic points. Taking just a step back for those who are new to India investing on this call, India is an ID market just like Korea and Taiwan. So any fund looking to invest into India needs an India investor ID called the FPI ID and an India tax ID called the PAN card. The FPI IDs are basically two categories, category 1 and 2. Who are category 1? Sovereign wealth funds, government-related entities, pensions, university grants, any regulated entities such as insurance firms, banks, asset managers, and any regulated funds or funds who have a regulated manager set up in an FATF country, an FATF compliant jurisdiction. Everyone else becomes a category 2 investor. Of course, category 1 has better access compared to category 2. Now, the good news and the linkage to VCC here is that Singapore is an FATF jurisdiction. And hence, any VCC structure set up in Singapore, which by mandate has a regulated IM investment manager here in Singapore, becomes an FPI category 1 eligible investor for India. And that's where the whole thing starts to make sense. If you look at traditional India investment pooling domiciles, Cayman Islands, Mauritius are all or both non-FATF signatories. And hence, suddenly the use case for VCCs investing into India becomes larger than life. If you look at how the whole VCC structure has been defined, unlike unit trusts or trusts, which were traditionally used for open-ended funds in Singapore, the VCC is a corporate entity. And that means that it has access to all the double taxation avoidance treaties that Singapore is a signatory to. Now, this is great because India and Singapore have a wonderful DTAA, or a tax treaty, which basically exempts any futures or options gains that you make in India out of a Singapore-based entity, and has a lower taxation for dividends, on capital gains on dividends. Of course, the disclaimer here being with recent changes in BEPS, MLI, and GAR, which is the General Anti-Avoidance Rules, it's always recommended for you to have a word with your statutory tax auditor or advisor, because you need to have real economic substance and purpose for setting up in a particular jurisdiction. And as long as you're crossing those boxes, you've got a comfortable treaty running on with India to invest into India from a Singapore-based VCC. Going to how exactly the FPI licensing will work for the VCC. Now, VCC is a new structure, as all of you know. We've only got 20 test cases so far. So we've officially written to the regulator, SEBI, in India, to get formal blessings on issuing FPI licenses to VCC structures. However, and once we get to hear back from them, I'll ratify the understanding with all the participants here by email. But our initial house view and discussions with consultants is of the view that, recently our regulator allowed protected cell companies or segregated protected cell companies to apply as FPI investors in India, and the same parlance can be drawn to the VCC. It's akin to, let's say, an Ireland-based ICAV, SICAV, or a Cayman-based SPCC. So you can either set up a single cell structure here in Singapore and apply for one FPI license on it and one PAN card, or you can have segregated cells, as the VCC allows you to do, and each segregated cell can apply as an independent FPI into India, which means you'll have segregated bank accounts, trading accounts in India, and anyhow by structure the assets and liabilities of a VCC in Singapore are all segregated, and you can create a similar structure mirroring that in your India investments. Coming to the PAN card, and our initial conversations with tax advisors are pointing to two possibilities. Again, I'll get more clarity as this regime becomes more prevalent. And the two possibilities are: you can get one single tax ID or India PAN card on the umbrella level, which will apply to all the sub-cells, so you don't need to apply for each PAN card for each cell. Or if you're, let's say, running a multi-manager structure, you might want to have even the tax ID segregated at the cell level. Both possibilities exist because we've seen both actually exist in the Ireland CCAV, ICAV structure or the Mauritius multi-class structure. And you should reach out to your tax advisor depending on which sort of structure on the Singapore VCC you see running. Coming to some key use cases that I thought are important or advantages from an India perspective on the FPI for VCC, we've already covered the tax treaty access, which is a big one in my mind for long short funds, for quant funds, anyone looking at futures in India, to trade futures in India. One big point, and again, this panel itself is an example of that. Singapore itself has a great access to fund service providers and the manager ecosystem, and setting up your fund, looking into India or investing into India as one of its core strategy in Singapore gives you access to not only a huge plethora of fund providers, but also a great time zone overlap with India. So if India has a strategy in your fund, you're 2.5 hours away, so you overlap with a lot of market calls, a lot of market releases, and hence the real purpose of coming into Singapore to have an India investment strategy is an easy one. You get all the funds set up as a VCC here will be category 1 investors into India, as I said, and then you get access to India synthetics as well. If you do P notes or ODIs into India synthetics, you need to be a Cat 1 eligible FPI, and the VCC is a clear answer to that. So that's again a big tick box in my mind. Also in the recent budget announcements, India has something called indirect tax transfer provisions. And, I can go more in detail on this on a one-on-one basis for those who are interested. But on the recent budget announcement, they clarified that Category 1 FPI investors have a provision of being exempt from this indirect tax provision. Category 2, unfortunately, are not. The Singapore VCC, as I said, is all Category 1, and hence you get exemption from the indirect tax provision as well. So again, an important use case if you're looking to invest into India as one of your core strategies. And one last bit that I want to touch upon is, and Rachel actually gave you a good discourse on it, is the REDOM case. And we're seeing a good number of managers reach out to us, both from Mauritius and Cayman Islands, talk to us about REDOM. We've also spoken to some Cayman law firms, and the REDOM is a real possibility. It's a one-way REDOM, of course, but with India being a focus area and Cayman Islands and Mauritius not being the choice one for FATF compliant country Cat 1s, the REDOM case is a big case, and I'm very happy to chat individually as and when required on how do we get the fund REDOM into a Singapore VCC and then issue a fresh FPR license, because the FPR license is not redomed. It doesn't migrate when you come in. We'll have to issue a fresh FPR license once you're here in Singapore. So that, were the 101s of what you should keep in mind with the new VCC structure. I'm personally quite excited about this, and I think this is only going to grow for India-focused managers or managers with one leg or one strategy coming into India. Rod, back to you.
Perfect. No, thank you for that overview. And I think, based on the early indications that we've seen just in terms of inquiries at a VCC, it's definitely going to be popular within the Indian market. Just moving back.
For sure.
Just moving back, I guess one of the topics we haven't covered, I guess, is corporate governance, and just in regards to board of directors. Martin, can you just give us a few minutes just in talking about corporate governance considerations for the VCC?
Yeah, sure, right. I mean, people are probably more familiar with the Cayman Fund and the corporate governance that goes with a Cayman Fund. I mean, historically, people were trying to prove that management and control sat offshore from Singapore to avail of the for the offshore status. As this is an onshore fund, the governance will have to be onshore. That may sound like common sense, but I think people still have not realized it. But your directors will need to be onshore for the restricted schemes in the alternative space. There is a minimum of one director needed on the VCC, and also that director must be resident, and one director or an authorized person or a regulated person from the manager needs to be a director as well. So technically, the licensed fund manager in Singapore can be the only director. Now, I think that's fine when it's proprietary money and maybe in the startup phase perhaps, but as we all know, when you start looking for third-party money or institutional money, you will need independent directors added to the board as well. So a lot of the funds in the pilot scheme didn't add in independent directors. The managers were the directors themselves. A lot of them were smaller funds and proprietary money. So it is a Singapore company. So meetings will have to be held in Singapore. Filings will have to be made with the relevant authorities in Singapore, and an AGM is required in Singapore as well. But you can opt not to have that and tell ACRA you won't have an AGM within 60 days of the AGM deadline. So I think they're trying to make it as flexible as possible by just having one director, which is good. But I think in the marketplace and when you're looking at corporate governance and due diligence, you'll have to add some investors to it. On the retail schemes, which are the authorized schemes, you will need 3 directors, and one of those needs to be independent. So that they will require independent directors on the retail schemes themselves. As long as, and for tax purposes as well, you want the directors to be onshore, but that doesn't stop offshore directors coming into the VCC as long as the minimum requirements are met. So one director from the manager, and they're being resident directors. You could have outside directors on the board as well. They don't all have to be resident.
Okay, perfect. Thank you for that, Martin. And I think, it's very similar to what we're seeing, but I think it gets back to the mind of management, what you mentioned earlier, and the actual control of the entity, which should be onshore. Look, there's a lot of talk about substance globally, Rod, particularly where you are in Bermuda and Cayman. By having the fund in Singapore and having the manager in Singapore, that covers about 99% of the substance requirements. So, when you are looking for the tax incentives and the double tax treaties with Singapore, all the hard work is done. You don't have to prove, to the tax authorities here that you are
the substance requirements are needed. So, so that's it with the directors. Rod, nothing really more to add.
Okay, perfect. No, thank you for that, Martin, and thank you to the panel, I guess, for all the valuable feedback so far. We have some time for some questions, and I see there's been a few here that's been submitted. So what we'll do is take some time to answer a few questions. I'll open this up to the panel, basically, that they can have a conversation about, whoever feels most the best background, I guess, to comment on the structure. So the first question that we'll answer, I guess, is there was a question here for you, Martin, and then we'll open it up to the panel. I believe Martin mentioned the attractiveness of the VCC to the Australia market versus Cayman. Can we expand? And I guess there's someone's wondering in regards to probably Australian investors in preference for the VCC versus the current Cayman product.
Yeah, look, there is, when you're marketing into Australia, when you're trying to market offshore funds into Australia and distribute them in Australia, there is a big stigma in Australia when it comes to anything offshore. They had a few high-profile cases where senior politicians were parking money offshore and they were found out to be doing that. So when you mention offshore, there is this view that if it is offshore, then there must be something sort of bad or untoward going on, which we all know is not the case. So Singapore is quite close to Australia. Both jurisdictions know each other quite well. The rule of law is strong in both. The regulators are strong in both. So, the Singapore regulator is seen very highly in Australia. So, the credibility factor is quite high. So, the other thing as well is on a personal level for Australia, a lot of people are looking at moving to Singapore as well. So maybe spending 50% of their time in Singapore, 50% of their time in Australia. But that's more of a personal thing as well. Also, in the tax authorities in Australia, once you start mentioning offshore, they get a little bit excited, and anything that doesn't fully comply with the requirements in Australia is heavily taxed as well. So, so between credibility, regulation, and taxes, Singapore is high on the list when it comes to distributions into Australia. I hope that adds a little bit of clarity to what I was trying to say, Rod.
No, I think that was good. And, if someone wants further detail, we can, I guess, between the panel, we can definitely find them the answers that they need.
Yeah, look, I'm talking to 3 Australians at the moment. One of them relocate, and 2 of them are going to use a licensed manager on the ground. And that's an option as well. So it's an Australian manager is going to stay in Australia, but you utilize a platform like something like Steve's at Swiss Asia, who become the resident manager, and then they will distribute the VCC back into Australia then.
Perfect. Thank you, Martin. Rachel, this question may be best suited for you, but I guess anyone on the panel can answer it, and I think it's a great question. I hear a lot of good things of the VCC, but is there a table comparing the advantages and disadvantages of this structure versus the existing BVI Cayman structures, tax, setup, and cost, etc.? And it's something that we've quite commonly seen in the market, usually distributed by law firms. But
Yes.
just wondering if something like that currently exists, or I guess is something that would be greatly needed in the market.
Yes. I work closely with the asset management team in PwC. In fact, we just completed a round of VCC seminar. So they published a comparative table between Singapore and about 10 other jurisdictions, kind of really line by line, feature by feature comparison. So certainly after this event, I can send you the link and we can publish it to the participants in this webinar.
Oh, perfect. That'd be great. Thank you.
Sure.
Another question I have here: what are the service provider types which the cost offset, I guess, is the VCC grant program incentive scheme that will be applied to? Is there further detail that we can provide, and maybe something better to answer and follow up that we'll distribute it to all the attendees? But is there a high level guidance in terms of the types of service party providers which the cost offset scheme will work towards?
Currently, the MAS website details are quite brief. Based on informal chat, and I can't really be quoted, but we believe, or I believe, that it will cover all initial costs, such as incorporation, legal, and also tax costs. It excludes all the filing fees that the fund manager has to pay to APRA as well as MAS.
Okay, perfect. Thank you, Rachel.
Yeah, Rod, that question has come up. But since the grant scheme was announced, everybody's very excited. They think they can get a setup cost. So we're talking to various service providers that are trying to get access to the grant scheme. So as Rachel said, it's really the setup cost. So legal, tax, compliance, fund administrators, if they are involved in the setup process of any of the vehicles. So as with most jurisdictions, the statutory fees and the government fees you can't claim back. Now, I asked as a director, I do a lot of consultancy in the early stages, and the fund administrators and a lot of the service providers do that. I asked MAS were those fees allowed, and they said a case by case basis, but I'm not sure if these consultancy style fees will be allowed. Rachel, what's your thoughts on that? I mean, it's very obvious with legal fees and tax and everything else, but if someone's trying to get a consultancy style fee, would you think that will be allowed?
I think from what the MAS has said at the sessions, in the last two sessions we've had, I personally don't think so for consultancy fees. It sounds a lot like the setup fees, like legal and tax, and also tax incentive application. And she mentioned regulatory as well. So, but I'm really not sure about consultancy.
Yeah, so Rod, it really is the setup cost and anything to do with setup. I had a software provider trying to say that they were trying to get into the grant scheme because they're going to be providing software to the vehicle. But, you know, a lot of people are trying to get access to the grants, but I think it's really the nuts and bolts of the setup, legal, tax, compliance, regulatory.
Yeah, and I would assume that basically that
it's not very, I think it's arguable to me is if you're trying to redomicile, say, a Cayman fund, and with a Cayman fund who is based out of Singapore and using people from the Singapore office, can we put it into the grant application?
Yeah, I expect that this would be the hottest topic in regards to basically the new structure. And there's another question here that says, what would be the expected cost involved in the VCC, given that it's a fairly new structure? And I assume the grant structure is to try to offset some of the learning costs or learning curve in the market to get this product to become more viable. Is that the intent of it, or do we expect that the grant scheme would continue on for a longer period of time than just the initial testing phase, or basically what we're going to now with the pilot program?
Yeah, the grant will last for 3 years, so that's quite a long time for a new product like this. And the grant term at 150,000 is pretty generous compared to previous grant scheme that the government has given.
Okay, perfect. No, thank you for that, Rachel. And I think, you know, there will be there's a few other questions here on that topic as well. I think what we'll do for the group is we will summarize answers to those and get the best possible answers out there. Also, as well, Rachel's available to take any questions, and Martin can help facilitate through his network as well if anyone has very detailed questions that needs further professional advice. Another question that I have here, and it actually is quite an interesting question because I see this quite commonly in family offices or fund of one types of structures. Can the fund have only one investor and still get the tax exemption? And I guess this is looking at the VCC and the common structure that we have offshore in terms of a fund of one.
Tax incentive.
And still get the grant scheme, I guess, if it only has one investor within the fund structure.
So I think people will be familiar with the 13R and 13X scheme. And so, for example, the 13X scheme comes in with 15 million. So I don't think the tax incentive is the number of investors, but if the other 13X, then it has to have the minimum 50 million fund size.
Okay, perfect. So we'll send around those minimum sizes. just so that everyone can take note of that as well. Another question that's here, and I think it's probably a little bit too complex to answer without further information, but it's a good question just to talk about in general basis for redomiciling. Is the investor consent required for redomiciliation of a Cayman fund? Martin, just from your viewpoint as a director, I have some views on this, but just want to get your thoughts on this in terms of, is an investor consent required for redomiciliation of the fund from Cayman to a VCC?
Yes, it's a material change, and it's changing the shareholder rights, right? So anything around that, would need shareholder consent, yes.
Yeah.
Plus, I mean, if you would also have to give them the right to redeem as well if you didn't get the consent. So, I mean, if those investors don't come with you, then you don't have a fund, right? So, so legally there is consent needed, and secondly, commercially they'll need consent as well. Otherwise, you won't have any AUM.
Okay, perfect. No, thank you for that, Martin. And that's my view as well, is that is a material change to the fund structure. We've had a few comments here that people couldn't hear Rachel clearly, but just for everyone's benefit, we will circulate these questions in a basically frequently asked questions document afterwards, probably a couple days following this webinar, and we will provide those details. So anything that you couldn't hear from Rachel's knowledge that she's shared with us, we'll definitely have that within the questions that we'll distribute to everyone. Another quick question here, and I guess I'll open this one up so that everyone can probably just provide one point. Would the panelists give a quick recap of the attractiveness of the VCC compared to the traditional Cayman Island structure, or we'll just leave it general in regards to the VCC structure? Also, would the actual managing of investments in a VCC be any different from that of a Cayman structure?
Do you want me to take that, Rod? Steve here.
Yeah, I think if anyone has any comments, but Steve, if you can lead off, I think that would be great.
Sure. I mean, I think that in the past couple of years, everybody that's been managing a Cayman fund has actually realized that it's no longer becoming hassle-free, but it's a lot of hassle actually. Regulations are evolving massively. It's becoming complicated. It's becoming extremely costly from a compliance regulatory perspective with all the submissions and so on. And I think that there's so many changes and so many requirements now that Cayman has actually put in place. It's becoming actually pretty cumbersome to manage a Cayman fund from a corporate governance perspective alone. Okay, and when I'm saying cumbersome, it's time consuming and also thus costly, because corporate secs need to do filings, they need to ensure that you're doing it. The lawyers need to draft certain documentation, certain policies, etc., on a yearly basis. So it's actually becoming, from my point of view, a pretty large hassle to have a Cayman fund. And I think VCC is coming in, and it's going to be way more streamlined and way more, we're going to probably save costs at the end of the day if you remove the setup costs, which are relatively expensive at the moment, probably because of the novelty. But I think that given time, we will see that managing a VCC will be a more cost-efficient and less hassle-prone than Cayman is right now. That's basically I'd say on a medium-term basis, and not even on a long-term basis.
Yeah, I think one other thing that I see as well, Rod, and Steve was touching on as well, is the whole distribution play, and distributing Cayman products is becoming more and more difficult. And if you're looking for institutional money or looking at the large multinational distributors, Cayman products are becoming very difficult to distribute. So the VCC is attractive from that standpoint. It is onshore. It is regulated through the fund manager, so it is quite attractive. Back to Steve's comment on the medium term, is when we go to BEPS and MLI and multilateral instruments, and that coupled with institutional investors asking, one of the questions going forward will be, is your fund domiciled in the same location as your fund manager? That will become a very important feature in the medium term. So if you say no, then you're going to cut out a lot of the institutional money on the medium term. So being able to have a vehicle onshore, be a manager onshore, and pool onshore, and then drop down to the investments is going to be an important feature going forward. So, and then maybe the third thing on the marketing side, when you go for sovereign wealth and institutional and pension money, Cayman is becoming harder to sell as well. So I think that the marketing and distribution is a very important feature of the VCC. And maybe lastly, when it comes to regional passporting with ARFP, when you go to passport your funds through Asia, the VCC will be the product that you'll want to passport and not a Cayman fund. So.
Yeah, and I think, specifically on that point, Martin, the passporting was one of the big discussions during the setup of the VCC, if we recall well, was the fact that PwC was actually also pushing for an automatic passporting with Europe, which would actually, given time, would be a huge benefit for all the Singapore funds to passport directly into Europe without having to hassle into getting representatives on the ground there, etc. Because right now, selling a Cayman fund or a foreign fund into Europe is really problematic and quite costly, I would say.
Yeah, and maybe let's not forget our friends in America. If you're going to market to American investors, the VCC has a tick-the-box exercise. So when they do the tax returns in the US, although it's a limited company, it is considered equivalent to an LP, and that is useful for US investors. You can have master feeders as well if you want to have US feeders into a Singapore master, and you can use US GAAP as the accounting standard under the VCC as well. So that's probably one other attractive feature for the VCC.
Totally, yeah, absolutely.
Well, if I may just jump in here on additional attractiveness, I think because the VCC is a corporate structure, so from the DTA perspective, it's very helpful to have a corporate structure because then you can directly tap on the DTA network that Singapore has with some 80 countries all over the world.
Perfect. Thank you. Thank you for that, everyone. And I guess, Martin, you touched on one topic. Actually, there's a question here. Is the VCC a suitable structure at this point for U.S. investors? And I think you mentioned the check-the-box election to be treated as an LP for flow-through purposes. So I think from that standpoint, most U.S. investors with a master feeder structure would still see, for taxable investors, would probably still go through a Delaware LP structure, but then the master fund could be the VCC structure. And for tax-exempt investors, they'd probably just go directly into the VCC. So that's a great selling advantage, I guess, that puts it on par with the Cayman structure, but yet now allows it to be in the jurisdiction with the manager and as well, basically, potentially where the trading strategy is located.
Yeah, maybe just one thing to add to that, Rod. U.S. investors know the GP LP scenario very well. You could have a Singapore LP to pool the investors, but the VCC could be the one that holds the portfolio if they really, really wanted an LP. You could have a Singapore LP on top with a VCC underneath for the assets, and then have a master feeder as well if you wish. So I guess it does facilitate the use of U.S. investors is the answer.
Okay, perfect. Thank you, Martin. One other question, and I think we'll basically then wrap up the webinar, but we'll still get to all the other questions and follow up later and distribute those out to everyone that registered for the webinar. But the last question is, could a standalone fund be redomiciled into an umbrella VCC, which is actually something I haven't seen before. Familiar with the segregated account structure or segregated portfolio companies, I've seen structures come out of those structures but not go in. So probably a question for Rachel.
At this point of time, the same legal entity coming across will come across in the same format. So if it's a standalone fund, then it will come across as a standalone VCC.
Okay, perfect. Thank you for that. And that's what I would have expected. But that's something else, I guess, if anyone has any further questions on that, you can definitely submit those and we'll get those answered through our panel. Thank you everyone for taking the time today to basically attend our webinar. We will follow up with an email with basically frequently asked questions, some probably links to basically useful information that you can utilize, especially in regards to the benefits, strengths and weaknesses of the VCC versus other domicile structures that we mentioned earlier in the webinar. So thank you everyone. Any other questions, please feel free to email us and we'll get those questions put onto a frequently asked questions that will be available on our website, www.kryptonfundservices.com. Thank you very much.
Yeah, thank you, everyone.
Thank you, everyone.
Thank you.
Thank you. Bye-bye.
Thank you all for taking your time tonight. I really appreciate you joining the panel. I think it's been a good, it's definitely a very topical topic, and I really appreciate your insight on this, the VCC, and I think there's definitely going to be more dialogue in the future.
Hey, hey, Rod, I think we still have quite a few attendees still here.
Okay.
So let's square those away and then we can kind of do final thoughts. Yeah?
Okay, perfect.
Okay, great.